Well, thank you as well. Let me first say that the sustainability of debt is essentially an issue of the long-term potential of an economy. And one thing that we have not looked at as much as we should in the last last 7, 8 years in the Greek economy is the productive possibility of the economy. In fact, from 2011 up till now, up till before the COVID crisis, we had, in terms of the productive possibility frontier of the Greek economy, we have a movement backwards instead of forward, because there has been a huge investment gap in the Greek economy. The Greek economy's investment gap is about 10 percentage points of GDP, and has been like that, sometimes 8, sometimes 6, for about 10 years. This has led to a long-term projection by the IMF of slow growth, and the debt sustainability exercises were based on this slow growth. We managed to have, up till the pandemic, huge budget results, 3.5 or 4 points of GDP per year in terms of primary surplus. And the solution of the let's say the exercise of Greek's debt sustainability was based on huge budget surpluses and low growth. That was the solution up till then. And we believe that the solution, the proper solution that is better for the sustainability of debt, is moderate surpluses and high growth. And most important, coverage of the investment gap. Now, the investment gap has three main reasons. One reason was because it is not as much today. I think today we have solved most of the problem. Was the very high tax rates and the very high labor cost in terms of social security contributions. We were much above the averages of OECD, and we have managed to solve that before the crisis and a part of it during the crisis, and will continue on that path. And this part of the problem, in my mind, is more or less resolved through what we have already done as a government. The second big problem was and is the difficulties for investors to actually make the investment possible in terms of how the various public entities and services operated. That covered a lot of things, from getting permits to how fast the ability to buy land or a building, lots of different things which had to do with how the state operates. This we have already started to solve, And in the Greek recovery plan, Greece 2.0, we are introducing a huge number of reforms. We introduced 58, if I remember well, different reforms. Most of them are going to change the way that the Greek state operates towards investors. These reforms, the advantage of getting into the Greek recovery and resilience fund and plan is that they are accompanied by specific milestones and targets, and both us and any government that will come will have to honor these milestones and targets for the foreseeable future. So these reforms will totally change the business-friendly attitude of the Greek state, plus big part of our plan goes into digitizing the state, giving priority to these services, from how fast the justice system will operate to the interoperability of the state permit mechanisms, so that you don't have to carry information from one part of the state to the other as an investor, etc. So this we will be able to change very fast in the next 2 to 3 years. There will be a totally different attitude towards investors. So this is something that will also change. The third main reason that we could not have investment as much as we should was and still is the difference in interest rates between Greece and the rest of Eurozone countries. On average, the Greek firms had to pay and have to pay 190 basis points for investments above what the European average, the other competitors in Eurozone paid. So this, especially for the smaller and medium businesses, where the gap was even bigger, was a big handicap for investment. Now, what we're going to do with the RRF loans is for the eligible investments, which means investments in green transformation, in digital transformation, extrovert investments, is investments in R&D and innovation, plus investments made by firms that are cooperating or consolidating, firms that are scaling up. All these investments will be funded with the RRF loans, which will drop the average interest rate for these investments, will cut the average interest rate for these investments about in half, which is going to be a huge advantage for Greece in the next years, because it will it will level the playing field with the other European Eurozone countries in terms of these kinds of investments. Of course, this is based on the fact that the firms themselves will put money as own capital, at least 20%, and then a third party, mostly a bank or a European banking institution, will also put at least 30 to 40% of the investment in commercial terms. And we will add there our own share coming from the RRF loans, which is going to be on average about 40% of these investments, but with an almost zero interest rate. And of course, all that under the EU regulations on state aid, which are going to be absolutely enforced in this case. So essentially, our plan aims to solve all the three main problems of the investment gap, and we intend to mobilize, adding both public and private investment through the Greek National Recovery and Resilience Plan, the Greece 2.0, about 57 billion euros of investment. Thus, we hope we will be able to cover a big part of the investment gap. We will add 7%, as the analysis of Bank of Greece shows, a permanent increase of our GDP, coming both from investments and reforms and the private investment that we're going to mobilize. And because about two-thirds of the investment in these 57 billion will be private. And this will change the trajectory of the Greek debt sustainability. So this is the plan that we have, and we are very confident that we are going to achieve much better results in the years to come than what has been achieved in the past 10 years. Thank you.